Welcome. In the world of investing, a great debate has raged for decades. What's the best way to analyze a potential investment? On one side, you have the detectives, the fundamental analysts, who pore over company financials to determine a business's true worth. On the other, you have the chartists, the technical analysts, who study price movements and market sentiment to predict future direction. Many see these as opposing forces, but the truth is they're not mutually exclusive. They are two different languages, both attempting to tell the same story, where the market might be heading. Today, we're going to dive deep into both, not to pick a winner, but to understand their core philosophies and, most importantly, how you can use them to build a more robust investment strategy. Let's start with fundamental analysis, or FA. At its heart, FA operates on a simple, powerful premise. A stock is not just a ticker symbol, it's a fractional ownership of a real business. Therefore, to understand the stock's long-term potential, you must understand the business itself. Fundamental analysts act like business valuators. They dive into financial statements, the income statement, the balance sheet, the cash flow statement, to gauge a company's health and profitability. They ask questions like, is revenue growing? Is the company managing its debt well? Does it generate consistent cash? They look for a company's intrinsic value. A key concept here is the economic moat, a durable competitive advantage, like Apple's ecosystem or Coca-Cola's brand, that protects it from competitors. By comparing this calculated intrinsic value to the current stock price, they decide if a stock is overvalued, undervalued, or fairly priced. This is the bedrock for long-term, value-oriented investors. Now, let's pivot to technical analysis, or TA. If fundamental analysis is about a company's value, technical analysis is purely about its price. Technicians believe that all known information, all the earnings reports, news, and economic data, is already reflected in a stock's price. So instead of studying the business, they study the price chart itself. Think of it as financial archaeology. They look for patterns, trends, and signals in historical price and volume data to forecast future movements. The candlestick chart is their primary canvas. They identify key levels of support and resistance, which are zones where buying or selling pressure has historically been strong. They use indicators like moving averages to smooth out price action and identify trends, and oscillators like the Relative Strength Index, or RSI, to gauge if a stock is overbought or oversold. For a technical analyst, the why doesn't matter as much as the what and when. It's a game of supply, demand, and mass psychology. So we have two distinct philosophies. Fundamental analysis is the detective, investigating the case to determine the true value of a company. Technical analysis is the psychologist, observing crowd behavior to predict its next move. The fundamentalist asks, what should I buy? The technician asks, when should I buy it? This is the core dichotomy. But the most seasoned market participants understand that this isn't an either-or proposition. The real power lies in synergy, using them together. Imagine this. You're a long-term wealth builder. You use fundamental analysis to create a watch list of financially robust companies with strong competitive advantages. You've identified a fantastic business you want to own for the next decade. Now, instead of buying immediately, you switch to your technical toolkit. You watch the chart and wait for the price to pull back to a key long-term support level, like the 200-day moving average, or for an oversold signal on the RSI. This is the hybrid approach, using fundamentals to find the quality and technicals to find the opportunity. It combines strategic patience with tactical precision. So, which path is right for you? The answer depends on your goals, your time frame, and your personality. It's not about choosing a dogma, but about building your personal toolkit. Think of it this way. Fundamental analysis studies the cause, the underlying health and value of the business. Technical analysis studies the effect, the price action that results from the collective buying and selling of the market. For the novice investor, start with fundamentals. Learning to read a balance sheet is like learning the grammar of investing. It's an essential foundation. For the active trader, technical analysis is your language of choice, but ignoring major fundamental shifts, like a disastrous earnings report, is trading blind. For the long-term wealth builder, fundamentals are your North Star, but learning basic technicals can help you avoid buying at market tops and add to your positions more intelligently during pullbacks. Ultimately, a holistic view makes a smarter investor.